What does it mean to be dependable? It means you do what you say you'll do time and time again. That's why the cattlemen of this great nation trust Ritchie to provide fresh water on demand. Ritchie, proud to be a partner to the American cattlemen since 1921.
Hello, I'm Marcus Brix with the CattleFax Closing Bell, brought to you by Ritchie Watering Systems. In the grand scale, fed cattle prices have been in a downtrending market since November 2014, when the weekly USDA cash price reached the 170s. Within 2016, markets remain in the general downtrend, but have also experienced the seasonal downtrend, which occurs in 8 out of 10 years. A typical seasonal fed market will make a high in the spring and come to a low in the summer. Since 1980, the average seasonal decline in fed cattle prices is 13.9%. From a weekly high of $139.23 per hundredweight in the third week of March to selling cattle at $115 per hundredweight in Kansas on July 20th, the decline from the spring high has measured 17.4% to date. There are currently 8 years since 1980 with a more severe break, but the downtrend is still in place. Interestingly, if the new cash market lows around 115 do not hold, the next level support is from July 20th of 2012 at 112.87 per hundredweight. Once the summer low is established, the typical fall rally in a seasonal year is 14.5%. A rally to this extent from a 115 cash market would price fed cattle around 130 in the fall, but this will be largely dependent on the cattle feeder's leverage position. At current packing capacity, the meatpacking industry can exert leverage over the cattle feeder. This leverage is measured by evaluating the fed price minus the drop credit as a percentage of the composite beef cutout. The smaller the ratio, the more leverage the packer holds over the cattle feeder, and this usually means they hold most of the margin. The ratio tends to make a low in the summer as fed cattle supplies are larger in that period. This year is no different, with the ratio making a near record low at 50.84% in the week of June 27th, following a 6.4% ratio decline. To provide context, the average summer low is 53%, with an average ratio decline of 5.2 points. As of last week, the ratio of fed price as a percent of the beef cutout had already improved by 2.67%, working to the typical seasonal increase of 5.6 points. The market will soon decide if a seasonal rally for both the fed market and the leverage component is in store. If so, this would suggest fed cattle should be back into the high 120s to low 130s heading into the fourth quarter. Thanks for watching. Remember to visit CattleFax.com to become a member and receive the latest market news and analysis.
The beef business has never been for the faint of heart. The pressures are real, the risks are high, but the opportunities have never been greater. So how do you sort through it all to decide which way to go? For more than 40 years, CattleFax has led the way. Become a member at www.cattlefax.com. We're the time-proven leader in research, analysis, and information, equipped with the industry's most powerful database. Our team is impartial, objective, our vision is global, and our focus is you. CattleFax, the deciding factor.